to talk to you what I think about the markets, the valuation of the markets. I've got some new material that I've never shown before. I said, hey, I'm going to introduce it to you. There's some of the new stuff I'm working on that has to do with demographics, the rise of the middle class, Asia, what that means for our future. I always start with this chart. I know many of you have been to my presentations before. And I start with this chart because it was this chart that gave me the idea and the motivation to write the book, Stocks for the Long Run. I spent almost 3 years gathering historical data on the major asset classes, stocks, bonds, treasury bills, et cetera, and so on, prices. I wanted to see how they behaved over long periods of time and whether that would give me any insights into what investors should do with their money. I'm going to show you the growth of wealth, starting with a single dollar in 1802. Reinvesting your dividends, let your capital gains ride. And all this is measured after inflation. That's what we mean by total returns. A single dollar in stocks turns all the way to $613,000 of purchasing power by the end of last year. If you put the same in U.S. government long-term bonds, the single dollar turns into $1,700. The same into treasury bills, into $285. Now, the next one of interest. I get asked all the time, Dr. Siegel, what do you think about gold in the long run? Well, I guess if your great-great-great-great-great-grandfather back in 1802 bought a little nugget of gold, which cost him one single dollar, and he put that nugget in a vault, not to be opened for, 208 years, until the great-great-great-great-grandchild opens it today and sells it at today's price in the open market. That single dollar of gold would have appreciated all the way to $4.27. Just a little bit ahead of inflation. That's all that the return on gold has been. But I'll tell you something, it's been a heck of a lot better than the US dollar. Dollar has depreciated in purchasing power by almost 95% over the last 2 centuries. Let's look at this chart. 1802 to 2011, average annual returns after inflation, the stock market 6.6% a year. Look at how stable it's been over long periods of time. 1802 to 1870, 6.7. 1871, 1925, 6.7. Stocks are real assets. They do well under inflation. They don't do well under really heavy inflation. People say, oh yeah, Jeremy, I know stocks give higher returns, but they're so volatile. I know I stick with bonds and they're low returns. Actually, one of the riskiest investments you can hold in the long run is U.S. Treasury bonds. This might surprise you. In all of history, there has never been a 20-year period where you've had negative after inflation returns in stocks. You have had them in bonds. And I'll tell you, looking forward, we're, in my opinion, exactly in that period again. People ask me, Jeremy, you think stocks are cheap? I said, yeah, they're cheap. Are they the cheapest you ever saw? No, I've seen them cheaper. Well, then, could they go down more? I said, I've seen them cheaper, but I have never seen them cheaper relative to bonds. And by the way, that is the asset class that is most important to compare stock returns to. From 1900, Australia, South Africa, United States, Sweden, Canada, New Zealand, Finland, UK, all the way down. These blue bars, now we extended it the next 10 years, so now we've got 110 years, exactly what I did, after inflation, real returns in stocks, bonds, and treasury bills. Here's stocks, bonds are the red bars, treasury bills are the green bars. U.S. is not even number 1 over the last 110 years. It's number 3, behind, surprisingly, South African returns the last 110 years have been better than the U.S., as well as Australian returns in every single country they examine. Stocks dominated fixed income assets and dominated by a wide margin in every single country in the world. 7.8% real return. That is what the current market is projecting for investors after inflation, capital gains plus dividends, 7.8% real return. That is more than 8 percentage points above TIPS, which are negative returns, minus 0.3. So the gap between the expected return on stocks and bonds is more than 8%. That's well more than twice its historical average, which is 3 to 4%. Something else that's really important. With the dividend yield on stocks above the bond rate, for the first time in over 50 years, 1957, 60 years, you don't need earnings to increase to do better in stocks than in bonds. This is really important. A lot of people tell me, oh, Jeremy, we're not going to get those increases. They're too high. I said, I don't care if they increase. They can stay the same for the next 10 years and you're going to do better in stocks because the yield is better already. You don't need the earnings to increase. That's extremely important, that you can sit with stocks and not need the capital gain to get you to where you would be with fixed income assets. You know, people say, well, what do you think is the most important economic development that's going to impact us over the next 20 years? The retirement of 85 million baby boomers, taxing Medicare and Social Security, absolutely important, no question about that. Buildup of unsustainable government debts and deficits has to be contended with. Breakdown of the European Union causes chaos there. That is a distinct possibility. Or, resource exhaustion, climate change, terrorism, you can go on and on. But if you actually look at the data and what is out there, the rise of the middle class in Asia and around the world is going to be the biggest economic phenomenon of the next 20 years. Let me show you the world over here. Right now, middle class spending $21.3 trillion, rising in 10 years to 35, in 20 years to $55.7 trillion. The question is, given the dynamics of the world in terms of the production, the consumption, the buying of assets, what the worth of the portfolio is, when are Americans able to retire? In the terribly pessimistic scenario that there is no growth in the emerging world, so they don't get any income and they're not buyers and not suppliers of goods, that is going to be the path of the retirement age. Very sharply higher. In other words, we won't be able to retire anywhere near where we're retiring now. We're going to have to work higher and higher until 77, even with life expectancy at 80. All right? With 2% growth in the emerging world, and that's only the same level we have there, it gets better. They buy more assets, supply more goods. At 4% growth, it gets much better. At 6% growth and at 8% growth. The single most important factor about our well-being over the future is actually going to be how fast the emerging markets can develop, their economies can, supply the goods that we need in retirement, and the wealth generated to absorb the assets that are going to be sold onto the market. Projection for growth in the emerging markets is between 4 and 6%, about 5%. The same slope as life expectancy. So when you get to 5% growth, this slope is the same. Now, what does that mean? That actually means there is a solution on the Medicare front, on the Social Security front, on the entitlement front, and all that. People have talked about it, but it also works out in a world map globally. If we start indexing our entitlements to life expectancy, and assuming the emerging markets can still grow at around 5% a year, we can continue to enjoy a pretty long retirement period. In other words, the asset markets will hold up, the product markets will hold up, the world cycle and demographics will hold up. If emerging markets fail and we don't get that growth there, then we're going to have a much shorter retirement period. We just won't be able to. Our portfolios will go down in value. There won't be enough value for us to actually retire as long as we want. Now this is the fascinating thing, if countries grow as fast as China has been growing over the last 20 years, which is 8%, 8 to 9% a year. India is now, 6 to 7% a year. Believe it or not, if they continue to go ahead, there will be so many goods that will be produced. There'll be so much savings that will be generated that we can continue the trend of the last 50 years and retire basically at a lower and lower age. I mean, that is the best case scenario. There are a lot of risks that are facing the market today. We can enumerate them. I enumerated them, on that previous slide. But there were risks all along the way of our last 200 years. And there was the Civil War, there was World War I, there was the Great Depression of the 30s, there was World War II, there was a double-digit inflation. We've always had the risks. I'm not saying that I don't believe the risks now are greater than normal. And even if they are greater than normal, you're more than being compensated in the price of stocks. I think that, again, on a relative basis, one of the most favorable valuation that you have on equities. It's even favorable on the absolute basis. Hey, I'm going to repeat what Warren Buffett said. You've never made a lot of money by betting against America in the long run. And I think that this history shows it. Thank you very much. Thank you for your attention. Thank you.